Good afternoon. Accounting 230, section 82078. Welcome to chapter 7 in our book. We've gone over chapter 6. At least I did my lecture on chapter 6. It should be available for you in Canvas and on my YouTube channel. So we're going to get into chapter 7 now, which is about inventory costing methods, cost of goods sold, and a few other goodies, okay? So I'm going to start by going through some of the PowerPoints, and then I'm going to interrupt that to go through what I think is going to be a helpful Excel session regarding different inventory costing methods. So with that in mind, let's get going here, and hopefully I'll draw an audience here. I tell you, this class doesn't draw too many people. If there's any baseball historians in the class, think of this class as the St. Louis Browns, who had tough time attracting fans. St. Louis Browns, of course, are the Baltimore Orioles now. And during the Great Depression, specifically the 1936 season, they drew 82,000 fans. Not for one game. That was the entire year's attendance. Can you believe that? That's kind of what we have in this class here. But I digress. I go off in sports world. Okay. Cost of goods sold and inventory, chapter 7. We don't need to worry about that. Keep in mind there's a cost principle involved in that the price you pay for the raw material, the price you pay for the goods you bring into your store may include other charges. For example, you bought a big machine or something, and you find out that it's going to cost $10,000 just to ship it across the country. Well, the cost of that extra freight is going to be added to the price of the goods that you're bringing in. If it's a type of thing where you have to spend a lot of time inspecting it and testing it, those costs would become part of the total cost of the item you're bringing in. And the same thing with preparation costs. Maybe you buy something and you can't fit it into your store, so you have to knock a wall down or something. And we actually had to do that one time where I used to work. So the cost principle, it means that you pick up all of the costs directly related to bringing in your goods. We're going to talk about different inventory costing methods here: FIFO, LIFO, weighted average, and specific ID. And what I hopefully will get across to you today is that each method is a choice that companies can make in terms of how they want to do things. One method will give you a higher net income than the other, and there's sort of a strategic thought process involved in choosing the method you want to use. We're going to start with a concept called total dollar amount of goods available. Think of it this way. You started off your bookstore and you had 1,000 books on the shelf ready for sale. That's the beginning of the month, the first day. And then during the month, you purchased another 9,000 books. That gives you a total available of 10,000. 10,000. Excuse me here. This thing is acting up. 10,000. That's your total. That's the total amount of units available for sale. You can't sell more than you had at the beginning, plus what you added to it. So at the end of the month, our job is to take the cost of those goods, the cost of them, and decide how much of that cost goes out the door in the form of cost of goods sold, meaning we sold the units, we no longer have them, and how much remains in the ending inventory. Now I'm going to skip through. I had a chance to look at these slides, and I want to go through these a particular way, okay? First in, first out. And by the way, that is not me in the picture, if anybody thinks it is. I did not pose for that picture. First in, first out. We're going to pretend, and I'm using the word pretend deliberately, we're going to pretend that we're selling the older goods first. We're selling the beginning inventory first, and then after that, we're going to sell the first purchase, the second, etc. In terms of LIFO, it's just the opposite. We're going to pretend that we're selling the newest arrival first. We're selling the newest arrival first. I can't think of too many businesses who actually do that, but I will give you one example. Your grandfather opened up a hardware store 50 years ago. And on that first day, he took a big 55-gallon metal drum and he filled it with nails. And people came in and they started to use, buy nails, weigh them out, and off they go. And then when that barrel got to be maybe 3/4 empty, your grandfather then piled a whole bunch of new nails on top. So really, theoretically, he never sold the first nail. That's kind of an example of a physical flow of LIFO. Keep in mind that these methods have nothing to do with the physical movement of the goods, except one method we'll discuss. These are arbitrary strategic decisions companies make in terms of how they want to present their income statement. And here, this is kind of a bad slide. Let's look at this. Yeah, these slides are not too hot. Okay, what I'm going to do is I'm going to take us into a new world here. I'm going to go into Excel and kind of show you what I wish the slides had done. So give me a moment to get warmed up here. Share screen. Voila. I hope I've shared the screen. Let's take a look at what we've got going here, okay? We have LIFO, FIFO, weighted average, and specific ID. Let's start with FIFO. FIFO is the most normal one, I would think you'd say. FIFO is the one that is the method that's easiest to use. And I would say most companies do use FIFO for that reason. So let's take a look at what we have here. We have a situation where we sold 1,200 units, right? In all of these scenarios, we sold 1,200 units. Well, let's see what we got going here. At the beginning of the month, we had 400 items there. And then we purchased another 200. We purchased another 300. And we had a third purchase for 600. We add these numbers up. We get total available for sale in units, $1,500. At the end of the month, we have to figure out how many of these units have been sold and thus go into cost of goods sold, and how many are still in the ending inventory. Notice the price structure. I'm assuming that the price went up all the time, 2, 3, 4, 5, etc. In this book and in all the tests you're going to get, we're talking about an environment of rising prices. We're not going to give you a problem where prices are going down. I'm superstitious. That would be a disaster for any economy if it goes through a long period of lowering costs, lowering prices. And in economics, they'll talk about that pretty extensively. In a healthy, thriving economy, you must have and you need just a little bit of inflation. You want workers to be able to make a little more money all the time. You want people to be able to raise their prices a little bit. And that rising waters will float everybody's boat, is what I'm trying to say. So let's take a look at FIFO, huh? FIFO. We have a total of 1,500 units at a total cost of 5,600. 4 times 2 is 8, 2 times 3 is 6, add them down, etc. Okay, let's figure out the cost of goods sold using FIFO. We sold 1,200, so under FIFO, we sold the first layer first. So we've got 400 times 2 plus 200 times 3 plus 300 times 4. So that's 4 and 2 and 6. That's 900. We get to the final layer. We only need 300 to come up with the cost of goods sold. 300. That's 4 and 2 is 6, and 6 is 12. So we costed out 1,200. That's hard to say. That means 300 remain in the lower level, the last tranche. So we have 300 left in inventory at $5. We price it out, and there we go. You have just computed the cost of goods sold at FIFO. In other words, we're going to go to our first level, and we're going to count the units: 400, 200, 300. Let's see, that's 4 and 2 is 6 and 3 is 9. We only need 300 out of here, which leaves 300 behind. So that's a look at FIFO. Let's look at LIFO. LIFO, last in, first out. So here we're going to start from the bottom. We're going to start from the bottom. And we're going to say to ourselves, we sold 600 first. Then we sold 300 and 200 from the next recent layers. That's 6 and 3 is 9 and 2 is 11. That means we only need 100 from the beginning inventory. We do our arithmetic, putting the correct prices down, 5432, and we cost it out. And let's notice something right away. Notice that the cost of goods sold for LIFO is considerably higher than the cost of goods sold for FIFO. That's because under LIFO, we're costing out the more recent, thus more expensive items first. So the key concept I'd like you to remember is LIFO will give us a lower net income than will FIFO. LIFO gives us a lower net income. So let's assume that these are big numbers. This is, say, 5 million, and this is 4,000,001. The difference is $900,000. The difference of $900,000 means that the LIFO people will pay that much less in taxes. 900,000 times, let's say, a 30% tax rate. That means that the LIFO people saved $270,000 in taxes. So that might be one motivation for going with LIFO. That makes sense, huh? Why would a company not do that? Well, there are some reasons. A company might choose FIFO because they want to make as big a splash as they can. They want to have a big announcement that says, aren't we great? We had so much, aren't we great? We made so much money this year. Our cost of goods sold was only 4,100. Our sales were, say, 10,000. We're going to show great numbers. So maybe a little bit of psychology in picking FIFO. Plus it's easier. Plus it is easier. And I think it gives you a smoother rendering of your sales and cost of goods sold. Let's go to the other two methods, okay? Third method on the lower right. The average cost method. This is a super easy one as long as you don't make one common mistake. Again, we're working with the same paradigm, the 400, the 200, the 300, the 600. We sold 1,200. We sold 1,200. Well, we had a total available of 1,500. We had a total available of 1,500. Excuse me, this thing is annoying me. 1,500. And the total dollars were 5,600. 5,600 divided by 1,500 equals $3.73. That's all you have to do. Take the 373 multiplied by the amount you have in the ending inventory, and there's your ending inventory. You can do, and then do the same thing for the cost of goods sold. You know you sold 1,200 times 373. So this method is pretty easy as long as you understand that the calculation is done horizontally on the available line. We want to go 5,600 divided by 1,500. Don't make this mistake where students will take 2, 3, 4, 5, and when they do that, you come up with an average of 3.5. which is absolutely wrong. And nothing's going to work out. You're not going to be able to agree back to the numbers you need to. Okay? Average cost. Pretty easy. Just have to remember that you get the average cost from that horizontal line. Now, specific ID is the fourth method we're going to look at. Specific ID is the one method that does follow the movement of the goods physically. Okay? Specific ID. This is for big ticket items. This is for a car dealership. This is for a diamond seller, a jeweler, where you're selling very expensive stuff in small quantities. You need to be able to track that car. When I bought my Ford Edge back in 2015, I handed the guy a check and the deal was done. But he didn't say to me, okay, Bob, go out to the parking lot and drive off with it, whatever Ford Edge you want. No, they had to know specifically which car I drove off the lot. They had to know the engine number, the VIN number, the block number, any other specifications on that car, the mileage perhaps when I drove it off, if there was any. They need that information in the event, God forbid, of an accident or a recall. So specific ID is pretty easy. They're telling you where the goods originated. So in my little example here, I'm saying we have sold the following. Let me do this way. Oh, I see what I did here. Okay, we'll do it down here. Cost of goods sold. What did we sell? They're telling us that we sold, sales came from the beginning inventory plus the first purchase plus the third purchase. Okay? Came from the first purchase from the beginning inventory, 400, 200 from the first purchase, and 600 from the third purchase. They are telling you 4, 2, and 6. 4, 2, and 6. You multiply it out, and that means we never touched the 300 here. These 300 are still in our inventory. So that's a look at the 4 different costing methods. I think you'll find this is not too terribly onerous. I think it's kind of interesting. I used to have to do this in pencil once a month, and I would spend much of a day on the closing, putting this together for maybe 40 or more different divisions. And I always kind of like doing it, but hey, that's me. That's me. Okay, so let me stop the sharing and let me go back to the slides. I'm going to go back up a little bit if I can. Here they're introducing you to the 4 methods, and we just showed how you break out the available line into cost of goods sold, meaning the stuff was sold or the goods are still in the inventory. Specific ID. These are the types of things that you need to track. This car has a VIN number. It has an engine block number. It has all kinds of information. It's got a secret VIN number that's hidden somewhere in different cars in different places. You have to track it. Diamonds. A jeweler doesn't just say, pick any diamond you want out of the display. Well, in a way you do, but when you pick up that diamond, that jeweler has somehow electronically etched in there. He can follow exactly where that diamond is going. I don't mean he has a tracker in there. I just means he knows the serial number of that particular piece of jewelry. Important concept that I think you already understand. The choice of an inventory costing method does not follow the physical flow of the goods. It has nothing to do with it. At least for FIFO, LIFO weighted average, specific ID is different. The average cost method. All you do is take the cost of goods available divided by the units available to get your average. That's all you do. And then we're back to this picture of me here, the first in, first out, and last in, first out. Comparison of methods here. This is worth looking at. I would just look at the net income line. FIFO gives you a higher net income. Simple as that. FIFO gives you a higher net income. LIFO gives you a lower net income. And that is assuming a paradigm of rising prices. If they ever gave you a question, which I don't think they will, and they tell you that it's during a period of deflation as opposed to inflation, then it would be just the opposite. But I don't think we need to worry about that. Now they're talking about the advantages of methods. First in, first out. The ending inventory approximates the current cost. Yeah, okay, I'll buy that. But last in, first out better matches the current costs in the cost of goods sold. So neither one is wrong. It's just a choice your company can make. And average, weighted average, you don't want to go too crazy with LIFO or FIFO. You can go with weighted average, and you'll have a number in between. Remember that under LIFO, the average cost was like $4 a piece. It was $2.50 roughly under FIFO, and weighted average, I remember, was $3.73 in between there. Managers' choice of inventory methods. Managers prefer to report higher earnings. They want to report the best number they can. They want to grab a big headline, especially at the end of a key quarter. Coca-Cola, the word on the street is Coca-Cola is going to hit $2 a share in earnings per share. Well, Coca-Cola wants to make sure they hit that, so they're going to use FIFO to make sure that their profit is going to hit the target of $2. If they used LIFO, they wouldn't hit the target. It's psychology. Nothing's changed. They still have the same earnings in terms of what the actual operation did. It's just the reporting of it. So some companies want to make that big splash. Others say, heck, I'm going to pay the least amount of taxes as I can. And LIFO enables me to do that because it's going to show a lower net income. If last in, first out is used on the income tax return, it must also be used to calculate inventory and cost of goods sold for financial statements. I don't think we get into that test-wise. International, we're not going to talk about that. And now we're getting to the end of this chapter, actually, with a concept called valuation at lower of cost or market. Inventory, ending inventory is always reported on your financial statements at its historical cost. We know that, right? You buy a raw material for $10 a pound. That $10 a pound is going to stay as the value of those goods as long as you own them, okay? If the value of them goes up, you can't anticipate that gain. You cannot anticipate the gain. You can only record a gain when you sell the item. So we're going to be comparing what's called the lower of cost or market. We're going to look at the cost of the item and compare it to what the market price is, called the replacement cost, which is the current price for identical goods. The company is going to recognize a holding loss in the current period rather than the period in which the item is sold. And this is part of the concept of conservatism. Conservative. The gap principle of conservatism tells us we can never anticipate a gain, but we always have to record a loss when we know about it. So let me get into the next slide, and let's finish up with a couple things here. Let's try to understand this and make it as simple as possible. We need to have an inventory expressed at the lower of cost or market. lower of cost or market. Market means replacement cost. So this company, Intel probably, bought 1,000 Pentium chips. They paid $250 for them. They paid $250 for them, okay? Well, they were selling them for $400. They were selling it for $300. But better chips come on the market, and they found themselves stuck with 1,000 chips that are now only worth $200. Only worth $200. So they have to recognize that loss of 50,000. So 1,000 times the lower of cost or market, which in this case is market, 1,000 times 200 is $200,000. Let's look at the disk drive. They have a little more luck there. They've got 400 sitting there. They paid 100 for them, and they're able to sell them now for 110. Not much of a profit, perhaps, but what's lower? In this case, cost is lower than market. 400 times 100 is $40,000. This inventory should be stated at $240,000, and the difference is $50,000. You have no adjustment at all on the second line. You have a $50,000 adjustment on the first line. And we're going to debit an account called cost of goods sold. We used to call it cost of goods sold dash lower cost market. And of course, the inventory value goes down. We're not going to talk about the LIFO liquidations. And these items here, we're going to get into a little bit later in the class. All right. So that takes us through chapter 7. Too bad nobody showed up. I had a whole bunch of good jokes ready, and I had my act down for you. But hopefully, by going through this Excel-wise, it helped make it a little bit better and make up for the clunky slides that I had to use today. All right. So I suggest we end the meeting, and hope to see you in tutoring perhaps later today or tomorrow at noon, or hopefully back in class on Monday. And good luck on the testing, by the way. It looks like we have a lot of good scores coming through from what I've seen. You guys take care now. Bye-bye.